or good afternoon, depending on where you might be. Thank you everybody for attending. Today we are going to do hopefully an informative session on tax strategies for our good friends in the architecture and engineering industry, and focusing really in on industry credits and deductions, some of which hopefully you'll be familiar with, some hopefully you can learn a little bit today and then take that back as something you can use in your practice. So with that, I'll start with a quick introduction to your panel for today. So hello everybody, my name is Mark Bacon. I'm a licensed professional engineer and I'm the head of our energy incentives team here at Leyton. And I've been doing energy incentives for quite a while here, done about 10,000 of these energy studies. So looking forward to chatting with all of you and hopefully helping out if you've got any questions or issues related to these. And I think with that, I will pivot over to my co-host, Andrew. Andrew, could you introduce yourself?
Hi, everyone. My name is Andrew Nlemadim. I have been in the industry now for a bit short of a decade, with my experience spanning the research and development tax credit, the 179D energy efficient commercial building deduction, and as of the Inflation Reduction Act of 2022, been working closely with for-profit business owners as well as non-profits take advantage of the investment tax credit. So to date, I've done several hundred energy studies, and now as a designated IRS enrolled agent, I work with taxpayers to make sure that their value is maximized while staying within the letter of the law.
Last but not least, Omar.
Thank you, Mark. Hey, everyone. My name is Omar. This is my 5th year doing R&D consulting with Leyton, helping a multi-million-dollar portfolio of clients claiming for the R&D tax credit. By background, I am an engineer. I have a couple of master's degrees, one in industrial engineering, the second in software development and cybersecurity. And before doing this, I have previously worked in several industries, including chemical, manufacturing, and others. And yeah, so I look forward to assisting.
All right. Thank you, Omar. And with that, let's move to our agenda for the day. For the next 45 minutes or so. So we are going to talk briefly through just a quick overview of the tax credits and incentives that are likely available for architecture and engineering clients. Specifically, research and development credits. We get a lot of questions around whether or not we qualify for these. So I wanted to get everybody on board with that. Omar will walk you through how that's going to work, and then I will talk through the 179D tax deduction. Hopefully some of you are leveraging that for your design work with some of your government or nonprofits, and I'll talk through why in case you've got any questions. And then Andrew's going to walk us through investment tax credit, as he mentioned in his introduction, and how you might be able to use those for some of the designs you're trying to do. And then finally, some case studies. So hopefully you're able to leave here with a few examples of what you can do. And with that, how do we have the credibility to be here speaking with you today? So obviously all of us work for Leyton. It is a very large global company. So we're in 16 different countries. We've got 50,000 clients, 3,000 employees. Been doing this for quite a while. So definitely do a lot of work in Europe and other countries, and really focused in on things like complex sections of the tax code. So I used to work for a fairly large CPA firm, and the way I like to explain it is when you deal with taxes, the tax code is really, really broad. And CPAs have a really broad understanding of all tax code. When you get into some real specific things, what a CPA tends to have to do is supplement it with a company like Leyton. So CPAs go broad so that companies like Leyton can go deep into sections of the tax code. And you'll find pretty quickly most of the things we're talking about, we exist because these things are complicated, and it's not reasonable to expect your CPA to do everything. So with that in mind, just a little bit of context on why everyone's here. We're going to walk through some of these incentives just to give you an idea of how you might be able to claim them. And we will pivot to Omar first. Can you walk us through research and development credits?
Absolutely. Thank you, Mark. So the research and development tax credit is a dollar for dollar incentive that allows companies conducting research and development to offset their taxes and free up some cash. Would you please be able to move to the next slide? Thank you. Yeah, so as I mentioned, it's a government incentive available to companies that conduct R&D either by creating or improving functionally an existing product or process, otherwise referred to by the IRS as a business component by their business or by their clients, right? In AEC, likely by their clients because it's an industry where professionals are hired on a contracted basis. So this dollar for dollar incentive will generally offset the income tax in some cases, and with additional criteria, it can also offset payroll tax liabilities. So what does this mean for you as a business? It means an immediate reduction in your income or payroll taxes. So you are going to be paying less money, which will free up cash that can either be reinvested in your business, conduct more research and development, pay for additional costs. Point being, it will free up your cash. It will also increase your net income, thus increasing your business valuation. And last but not least, it can also be banked. So if you are unable to benefit from it immediately, you'll be able to keep your credits and carry them forwards up to 20 years to offset the aforementioned taxes.
Yeah, thanks, Omar. And we had a question coming in, and I kind of handled a little bit the introduction, but we often get the question, why not just use a CPA? Because we're talking about tax liability, like why would you even need a company like Leyton to help out with an R&D tax credit?
That is a great question. Thank you, Mark. So there is a multitude of reasons why you would choose a specialized firm like Leyton versus your CPA. To be brief, I can cover maybe a couple. So the first one would be specialty and expertise. So as you mentioned, CPAs tend to be broad, whereas Leyton tends to be specialized, right? So we are more up to date with regulations, and we know how to navigate the R&D tax code better. Your CPA generally will be competent enough to navigate your taxes, but with specific credits, it's quite beneficial to hire a specialized company, especially if the claim is multifaceted, complex, and it's big, right? Second one, better documentation. So we know what to request. We will draft your robust documentation. This will be super beneficial in case of an audit. There has been scrutiny on the R&D tax credit. Companies get audited, and if you are unable to defend your projects, your credit might be disallowed. So basically, we pledge to defend you if something like this happens, and we ensure that only qualified things get qualified, and the adequate defense is available. Last but not least, I could also maybe mention maximizing your claim value. We know what to look into. We bridge the gap between technical and tax, and we know what costs to qualify, what projects to tackle, and generally we won't overlook costs, and we will maximize your claim value versus claiming with your CPA.
Well, hey, I'm biased, but you sold me, Omar. So let's go to your next slide.
Sounds great. Thank you. Yeah. So in order to qualify, you'll have to pass a technical test referred to as the four-part test. You'll need to develop something new or improved, a product, process, formula, software. This is referred to as a business component. Everything needs to be technological in nature. Good news is architecture, engineering, and construction are technological in nature activities, so should be good. You need to face uncertainties as evidenced by the existence of iterations. And last but not least, these uncertainties need to be resolved using the scientific hypothesis methods. This test is generally reflected in several activities generally conducted within the AEC industry. So if you do any of these, you may be a really good fit for the R&D tax credit. The first one is developing new designs and improving existing designs. And this usually happens during the DD and ST phases. So if you conduct iterations, improve designs, these are business components and should showcase that you could be eligible for the credit. Second one is the usage of BIM, CAD, and other digital tools for design. Another one is developing environmentally friendly buildings, energy efficiency, pursuing LEED certifications. Another one, incorporating innovative MEP or HVAC systems, evaluation of different materials. And another one is also historical restorations. This is a bit niche, but it's a good fit for R&D because you are working, with specific regulations, and you have to maintain a certain look for the building, and also overhaul it, right? Structurally HVAC, MEP, basically bring it to 2025 while maintaining that classic look, which can entail uncertainties.
Sorry, no, that makes sense, Omar. And actually, we had a question come in the chat. It actually applies for 179D as well. So I'll try to answer this later. But what if you are just building to code? Like you've got code requirements, you're not really doing anything new or innovative. Are you still going to qualify for R&D?
Good question. So with competent professionals, there is usually I guess we could call it an imposter syndrome, where activities could seem routine to you, but they would be R&D nonetheless, because you are so good at your job and you are so used to it. It could look routine to you. To answer your question, building to regulations in of itself doesn't qualify any activity as long as it fits the four parties. Should be so good. Building to code sometimes can lead to valid uncertainties and the valid process of experimentation, and there would also be a business component there, and everything should be technological in nature. So it would be a good fit nonetheless. So I wouldn't say that it would inherently disqualify an activity, if it's building to code.
Okay, great point. And I'll handle the 179D later, but building to code does still qualify you for 179D in the short answer. All right, Omar, and I think we've got you for a couple more slides. So what can we claim?
Good question. So as we mentioned earlier, if you do any of the aforementioned activities and you fit the four parties, we'd be happy to discuss this, qualify any eligible projects. But if you manage to do that, you are able to claim certain costs that go into these projects, right? And there are four cost categories. The first one is the salaries or W2s in general of any employees working directly in R&D, resolving challenges and uncertainties. Also, any employees supporting them. And last but not least, employees supervising them. So salaries of these employees can be claimed, right? Certain percentages of these. Second one, it's very big in the AEC industry because contractors are regularly hired to conduct R&D activities. It would be subcontracted costs or 1099. So if you hire any contractors to resolve an uncertainty, we could claim a percentage of the cost going into paying them. Third one, raw materials and supplies to conduct research. So if you utilize any fully consumable supplies to resolve the uncertainties, conduct testing, evaluate potential solutions, materials get wasted and costs go into them, you are eligible to claim a portion of these costs as long as it's within the scope of an R&D project. And last but not least, this is generally not something that would apply, in my opinion, to architecture, engineering, and construction. But if you use any cloud computing tools like Amazon Web Services, Microsoft Azure, or other, for example, to do computation, conduct simulations, and anything of the sort, as long as it's not storage, it's actual computing, it should be good. We should be able to claim back some of these costs, which can be pretty huge in my experience for AWS or Azure.
Great, thanks, Omar. And I think last for you, and then you're off the hook for a little bit, is you've got a couple minutes to walk us through a case study.
Yeah, so this was a good client that we worked with. This is what I would call an average claim. It's not huge, it's not very small, so it's a normal mid-sized company. So for this company, they worked mainly on an improved technique for acoustic noise mitigation, basically improve the sound deadening inside the building. Another one was improved energy efficiency, make the building more efficient. And last but not least, they also fully automated the MEP control system. So this was part of an improved business component, i.e. the building already existed, but they improved it. So for this company, there were 15 employees, some of them directly doing R&D, others supporting and supervising them. There were no qualified supplies. It was mainly design, and they had they didn't hire any contractors, and likewise, they didn't spend any costs on cloud computing. So we focused on the salaries, on the W2s, and we managed to claim 21% of their employees' time, meaning that the 15 employees spent 21% of their time roughly working on the projects that I outlined. And this resulted in a credit claim of around 82K over a 3-year look-back period.
Great. Thanks, Omar. And those of you with sharp eyes may have noticed the poll just opened up. I just want to get an idea on whether or not you have been claiming R&D in the past. And if we go to the next slide, you'll actually see the poll question. So we'll give everyone a little bit of time to answer that. Realistically, I'm probably going to move on to my next slide. And then, as you're listening to me, feel free to get your poll answer in, and then we should be good to go. So I see a few questions in the chat here. I'm going to go back and make sure we answer those as we go. But in the, to make sure we get enough time here, we'll get to some of these questions at the end. Well, it looks like we have a very informed audience who already answered some of the questions as well, so that's great to hear. So I'm going to talk us through 179D tax deduction. So that is for energy efficient commercial buildings. So if you are designing commercial buildings, this is probably something you want to listen to a little bit. I'll give you a little bit of background. I don't have a lot of slides here, but it is, like I said, for energy efficient commercial buildings. If you look at the history of 179D, it's actually been around since 2006. It was part of the Energy Policy Act of 2005. And the basic intent behind it is what uses a lot of energy is commercial buildings. If you look at what using energy all across America, commercial buildings account for a lot of it. Some people estimate up to 40%. So we want to reduce that. How does the government reduce things? Well, they offer tax incentives to do it. It's a really powerful mechanism the government has at their hands. Now, what happened with 179D is it wasn't leveraged well enough. It was originally for commercial building owners in 2006. So in 2008, they extended it and they said, okay, now architects and engineers for government buildings can leverage it. And the basic reasoning behind it is there's a lot of government buildings. Imagine military bases, schools, some, lots and lots of different office buildings, tons of space is actually owned by the federal government. So they said, okay, since we don't pay taxes, we can't take a tax deduction, but the architect or engineer who designs our building can take the tax benefit. So that is via an allocation process. So if you're an architect or engineer and you're working on government buildings, you can be awarded that tax deduction. And then what they did is every few years they would extend 179D and expand it, and the value went up. So it keeps going up. And then if for whatever reason you have heard of 179D, probably because of the Inflation Reduction Act. So what the Inflation Reduction Act did is it basically added a 2.5 times multiplier to 179D. So it went from being worth about $1.88 per square foot all the way up to north of $5 a square foot. So in 2025, it's worth $5.81 a square foot for any building that you place in service. They further extended it not just to government entities, it's extended to all nonprofits. So basically, if someone doesn't pay taxes, they are able to award the tax deduction to the designer. So that includes nonprofits. So think a lot of churches in America. If you're designing a church with your clients, for instance, as long as the building's large enough, they can actually award that tax deduction to you. It's a really, really powerful incentive for those of you who are out there designing things to try to figure out, okay, I want to do energy efficient design. Most of you are here because you want to do the best design for your clients. And I think all of us know cost becomes a very big consideration when you want to go do something. Let's say, for instance, you're trying to decide between, a regular gas rooftop unit versus geothermal heat pumps. You're going to want to be able to put some of these tax incentives on the table to help incentivize your clients. And Andrew will walk through how you can do that with ITC as well. The difference is with 179D, you can directly take the benefit for that if they are a government entity or a non-tax-paying entity. So you get a couple options for how to leverage 179D. One is if you want to do interesting design for a for-profit, you tell them, hey, there's this tax incentive out there you should be looking at. It'll help fund this innovative design. The second angle is for nonprofits, you can just be awarded that deduction for the energy efficient choices you make. And we had a question earlier in the chat about what if you're just building to code. That applies for both R&D, but for 179D, the interesting thing is we are comparing to an ASHRAE standard. That's how we decide, are you doing energy efficient buildings? We take the building you've designed, we compare it to an ASHRAE standard. That standard is ASHRAE 90.1, 2007. So you can imagine if you're building to code in California, you're doing significantly better than ASHRAE 90.1, 2007. So even if you're just building to code, you may be eligible for 179D tax deductions. Now, some people say, well, why is that? And the idea is these are supposed to be achievable standards. So stepwise incremental changes to be better. We don't want that 1980s boiler sitting in the basement anymore. So we want to incentivize people, upgrade that boiler, put in a condensing boiler, do what you need to do to make it more efficient. You put in control systems, do all of these things that will make the country more efficient. That's the reason why all of this really exists. So if you look through the history of 179D, you can see they keep doing it. There is one really big caveat here, and I'll go to the next slide for a little more information. Really what you're looking at is HVAC, interior lighting, and building envelope. If you're a designer and you're working on any of those three systems, you should be considering 179D, especially if you're working on it for a nonprofit or a government entity. The good thing is, it is now a permanent part of the tax code. As of 2020, it's permanent. As I mentioned before, the history of it is it gets extended every few years and expanded. But every couple of years, I've been doing this for a while. I always thought I was going to lose my job because you didn't know if it was going to be part of the tax code moving forward. Fortunately, 2020 came along and now it is. So I'm a little bit less risk of losing it. It does require a couple things. You have to have a licensed professional engineer verify the study. You have to do an energy model, as I said, to ASHRAE 90.1 2007, and you have to do a site inspection. So that really means you have to go third party. So it actually, even in the tax code, says you have to use an unrelated third party engineer to do the study. So that's the reason why, to some of our earlier discussions, your CPA doesn't do that by themselves. Now you can carry forward the tax deduction. So it is valuable even if sometimes architecture firms and engineering firms are running razor sharp margins, but you can carry forward that as a tax deduction if you don't have enough taxable income in the current year. The big thing though, and as I mentioned before I switched to this slide, there's a string attached to these larger values. At $1.80 or $1.88 per square foot, no problems. Moving up to $5.81 through the Inflation Reduction Act, they said you have to do two things to qualify for that $5.81 a square foot. You have to be paying prevailing wage, and you have to have a registered apprenticeship program. Those are the strings attached. And I see someone in the audience kind of jumped ahead to talking about prevailing wage, because if you are familiar with 179D, you will know prevailing wage is a big deal. And actually, fairly informed person here on union. So when you think about prevailing wage, the first word that comes to mind, first two words really, are union and Davis-Bacon wages. So if your clients you're working with say either of those words, there's a pretty good chance they're paying prevailing wage. If they say, we don't do unions, we don't do Davis-Bacon Act, they're probably not going to be meeting prevailing wage. So that means you don't get the full $5.81. It actually drops down to about $1.13 per square foot. So it's something you really need to consider. And as I mentioned at the start, the reason why we're moving into specialty space here with these tax incentives is that's a pretty nuanced piece of information for your CPA to understand. That's the reason why we partner with these CPA firms, but we do this work for them because things like this get really complicated. So prevailing wage can be challenging. We do find people meet it a lot. There's also a grandfather clause. Depending on when you started your construction, you can leverage safe harbor rules to say we started the construction. That is, any construction that started before January 29th of 2023, you're grandfathered in to this full amount. So you got to really start looking at safe harbor rules. When do construction start? So there's a lot of nuance here as you go through. I've got a case study to go through, but honestly, I can do that really quickly. So I do want to handle the question that Jeremy asked here about design companies that are ESOP. So the challenge, so ESOP is if you are employee share owned, you probably have a lot of owners. I don't know necessarily how many owners you're going to have, but the value of a tax deduction gets diluted based on the number of owners you have. So some ESOPs I've worked with in the past have 1,000 owners, 1,000 employees. Even if you take $1 million tax deduction and divide it over 1,000 people, it definitely dilutes the value a lot. So Jeremy, we probably want to look into the structure of your ESOP just to see if it makes sense. Technically, you can take the 179D deduction from your government project. We would just want to look into the structure of the company to figure out, basically, is the juice worth the squeeze? Like, is it worth investing the time and energy into it based on how much we dilute the value? So great question. It comes up pretty frequently. So tax structure is one of the biggest questions we have for, should you take 179D? I can answer the technical questions. I've done 10,000 of these studies. It's the financial questions that are the ones that really take some time to figure out. All right, and I've got about a minute left here, so I'm just going to go through a quick case study just to give you an idea of what you're working with. Fairly typical building, about 100,000 square foot office building. This was back in 2022, so pre-Inflation Reduction Act. In 2022, the value was $1.88 per square foot. In this case, this building basically put in new boilers. And then the boiler affects the entire building. As you generally would know, they're connected to everything. So because they put in new boilers and then associated systems with them, they were able to get that full deduction of about $200,000. And that just went straight to basically accelerated depreciation in the building. So very valuable study for them to be able to do. Replace your boiler, you're getting $200,000 back in the form of tax deductions in that year you put it open. So fairly simple. I will say we've got another polling question open here as well, just asking people like, hey, have you done 179D? Hopefully some of you have. I'm not exactly sure of our structure or audience here, but if you have had a chance to use 179D, it is very valuable. If you haven't, please reach out to us and we can help you kind of walk through it and see what kind of questions you have. But I will answer the poll question myself. And then I think from there, I am going to pivot over to, well, so I'll show you the poll question first, and then I'm going to pivot over to Andrew. So poll question is basically, have you previously taken advantage of 179D energy efficient commercial building property deduction? Again, hopefully you have. If you haven't, please reach out to us. And with that, Andrew, I will pivot over to you to talk about ITC.
Thank you, Mark. All right, so let's talk about ITC, the investment tax credit. This is one of the biggest financial incentives out there for integrating clean energy systems into commercial buildings at the federal level. So unlike the 179D, which architects can directly claim, or the R&D, which rewards innovation for architects, the ITC in most cases won't necessarily benefit the architects directly, but it absolutely impacts your projects and can help you tangentially. So if your client doesn't understand how ITC works, they could be leaving money on the table, and that could, make your job harder when pushing for sustainable projects or energy efficient designs. So in the next slide, I'll break down the ITC in the way that it makes sense. So what is the ITC? Simply put, it is a federal tax incentive that helps business owners recoup a percentage of their investment into clean energy systems. So think things like solar, electrochromic glass, microgrid controllers, geothermal heat pumps, and battery storage. Those things that are typically integrated into commercial buildings can qualify for the investment tax credit. So the base credit starts at 6%, but if the project meets the same labor standards that Mark had talked about, prevailing wage, it could jump to 30%. A bit of a difference there is that systems that have a electrical output of less than 1 megawatt are actually waived from prevailing wage requirements. So your typical rooftop solar projects, or maybe a geothermal system that is under 284 cooling tons would also be waived from apprenticeship requirements and would be able to receive that full 30% base credit. It doesn't stop at 30% though. It actually can go as far up to 70%. Though unlikely, there's a couple of caveats there we'll talk about in a later slide, but there are also bonus adders. So this is where architects come in. Your design choices, so things like integrating solar or geothermal from the beginning, can help clients take full advantage of these incentives. So think about it this way. If the ITC was like a cashback offer, instead of getting 5% back on groceries or 1% back on all other purchases, you're getting literally 30% back on potentially multi-million-dollar systems. And that can rise to, say, 50% in the case of a geothermal system. Okay, so who can benefit? An interesting thing about the ITC, it has been around since 1962 and has been in place since to stimulate the economy and to be used as a tool to have the U.S. invest in certain systems you can imagine in the 1960s, it was more based on coal plants, advanced gasification. And now, since 2005, you saw solar into the picture, and it has only been further enhanced. Fast forward to 2022, we're seeing the largest incentive in clean energy. So the Inflation Reduction Act also allowed for not only for-profit business owners to take advantage of it, but maybe less tax efficient investors as well. So we have commercial developers that we see take advantage of it, as well as schools, offices, industrial buildings, nonprofit, local government, tribal entities as well. And there's a plethora of technologies that you see here on the screen. And as I mentioned before, geothermal heat systems we often see, as well as rooftop solar and fiber optic as well. Those things that might be integrated in a design, whether it be through passive house certifications, net zero, or Energy Star. We see that a lot of commercial buildings often have these systems that also qualify at the federal level for the ITC. And also, where you could come in here is many clients might not realize that these incentives exist until they're too far into the project to qualify. So that's why bringing up these conversations early and before maybe materials are selected or contracts are finalized could make a huge difference. So you can be a strategic advisor as an architect and not just a designer.
And Andrew, we had a question come in the chat, and it's something I kind of haven't been in the space for a while. I was wondering too. So obviously you designed a really nice building, really nice roof line. You don't want someone slapping a rooftop unit on top of that and ruining your nice skyline view. So a lot of people go to things like geothermal. So Colin asked in the chat, like 2 years ago, we did a geothermal project, probably because the one of the building looked nice. Can you go back and do that? Can you go back and take ITC from a project from 2 years ago?
Absolutely. If you are a for-profit owner, general taxes allows you to look back generally 3 years. So we could make an amendment, find those savings, do a cost analysis, and figure how much of that geothermal system could qualify. And also we could work to adjust your depreciation, as there is an accelerated depreciation benefit there as well. Now, if in the case of a nonprofit, or what we call an elective pay entity, that is a timely filing election, you may not be able to receive a allocation, or a registration number, which would then allow you to receive your cash payment. Those need to be done timely, and it's best to get ahead of that prior to filing deadlines.
Great, thanks, Andrew. And then, all right, you get a nice bonus adder graph here.
Nice, yes. Moving on to the bonus adder graph. So the Inflation Reduction Act did allow other entities to take advantage of it, and they also beefed up this credit to 70%, something that we hadn't seen before in the past with any other tax incentive. So the first two things we mentioned, which were the 6% base for investing into a specified group of technologies, that automatically jumps to 30% if the prevailing wage and apprenticeship requirements are either met or waived. And this is if your project started construction after on January 29th, 2023 or after. You are waived if construction had started prior to that. And you also get a 10% domestic bonus credit if key materials were manufactured, mined, or produced in the United States. There often is about a 40, sometimes 45% threshold for these more recent projects, which is only going to increase as time goes on. There's also a structural steel and iron requirement. That's pretty much a bright line test there. So if you have any structural steel or iron that is being integrated into a project, that needs to be 100% mined, manufactured, or produced within the United States in order to get this 10% domestic content bonus. The other bonuses for the energy communities and the low income are more geographical driven. So if projects that are in an area that used to be dependent on fossil fuels, things like old coal plant sites, they get another booster. So that's where site selection, it can be interesting, but also not as controllable. The low-income community bonus essentially works in the same way. If your design includes low-income housing or community-based projects, the ITC can go up another 20% there as well. So when these things are stacked correctly, the adders can pretty much add up. We typically see 30, obviously, and as high as up to 50 or even 60%. So it's huge for project financing.
Oh, that's great, Andrew. I mean, that's awfully, obviously a lot of money if you can take 30 to 50% back of the cost to install as a tax credit. So Jeremy asked a really interesting question, and Jeremy, I love your question. So dynamic glazing. Have you heard anything, Andrew, about that coming back as an eligible measure?
Dynamic glazing. So this is definitely technology specific. Would definitely have to look and at the energy property requirements to see if this specific technology could qualify. It is based on facts and circumstances and what the project allows. The good thing about the regulations is the DOE in partnership with the IRS, work together to future-proof some of this guidance for more advancements in the space. So if you can think of thermal energy storage, combined heat and power, things of that nature, they definitely wrote it in a way that could allow for people to be innovative and also still meet these requirements. I know that with electric plummet glass being on the table, which is essentially using electricity to change the shading on a window system, things like that qualify. Potentially dynamic glazing could, but I know smart glass is definitely in the picture there, and it's worth evaluation.
Yeah, I think Jeremy raised a good point. Yeah, they just let it sunset. So 48 is moving to being technology neutral. So that's another factor. So I would say for things like that, Jeremy, we tend to move into a lot of these become research projects. So these are the type of things that we need to do a deep dive. As you can see from the list of technologies here, it's hard to be an expert in any of them. So you kind of have to research them all independently and figure out how all the components come together. So it's just there's a lot of moving parts in ITC. Each one is effectively its own service line, is what we've seen.
Absolutely, and it's also very timing specific. So the dynamic glazing, or say, if assuming it's electrochromic glass, if it started construction prior to 2025, it could still be taken in tax year 2025. So paying attention to the beginning of construction rules as well as the place in service rules are extremely important. And that also leads into the next question there on the low income community bonus. A missed application deadline, is it too late? And that, for the most part, if you have already placed the system into service before getting an allocation from the DOE, then you're out of luck there. You would not qualify for the low income community bonus. The IRS and DOE require you to apply first, get an application, and then place it into service within 4 years. So there's some back end reporting there. So if you've already placed it into service, there's not really a way to retroactively qualify. And that's another reason why it's critical to work with an advisor ahead of time to make sure you're hitting the right steps in the right order. And my last note here is, in general, design choices matter as architects. And if your building does incorporate solar, battery storage, or geothermal from the start, the ITC can fund a major chunk of that. And material selection on these tax credits as well matter. So if your specs maybe call for any type of material and don't really delineate between, say, domestic or imported materials, your client might also be leaving money on the table. So it's worth the conversation in the earlier phases of construction to maximize your client's value there. And we can definitely help out with that.
Yeah, that's a great point, Andrew. Because actually I was in a discussion with a fairly large engineering firm a while ago, and what they were doing is they were trying to decarbonize a building. And they had basically 3 options: option A, option B, option C. Option C obviously is the best one. Option A was basically just building the code. And those conversations largely come down to cost. I really would encourage people to layer in things like ITC to say, look, the lowest cost might be code, but you really want a building that is as sustainable and resilient as possible. If you layer on things like ITC, maybe you can choose option C because now it is cost effective. Like couple that with cost segregation studies and with 179D, and then all of a sudden these what appear to be higher cost incentives are in place pretty quickly. So I would really encourage all of you who are out there. I know you're designing really cool stuff and you want people to choose the cool thing. You don't want them just to pivot back to code. Really try to layer these in, and we're happy to help you in those conversations if it ever does come up. And I did, hopefully everyone has seen here, there was another poll question. We've got about 4 minutes left. We had a really interesting question coming from Kristen here. I'm going to answer that in a second here. But I will quickly click through a few slides here just to close out the presentation so everyone's got the full information. So research and development, Omar already walked you through that. If you have any questions around those credits, that can include just base R&D credits, payrolls, grants and incentives as well. There are a lot of those out there, and then orphan drugs. Interesting one to layer in is state and local tax. Thing that I've learned lately is it gets really interesting around things like, for example, sometimes it really gets in the weeds where like you pay taxes on 3-inch PVC pipe, but you don't pay taxes on 2-inch PVC pipe. So like you may have clients out there who are overpaying on taxes on really small details like that. So we have a team that helps with that. And then these are a lot of the energy incentives that we already talked about. We spent a fair bit of time on 179D and 48 with Andrew. 45L is for the residential developers. We didn't talk through that because a residential tax credit cannot be issued to the architect or engineer. But if you have residential clients, I would encourage them to consider doing this. And then cost segregation is kind of the big brother of all this, is the accelerated depreciation. And with that, I'm going to go through and answer a few of these questions in the chat because we came in with a few good ones here right at the end. So probably it will only be able to handle Kristen's question here because it is the hardest question we get asked on any one of these webinars is current administration. What does it mean with the current administration? In every panel I speak on, every conference I go to, this is basically the first question everyone asks. So glad you asked that, Kristen. So couple things. So one, I mentioned 179D was made permanent in 2020. It was the current administration that did that. So that was one of Donald Trump's things that he did, is he made 179D permanent. Also, energy credits, those Section 48 that Andrew was talking about, they are actually largely traded by large banks. So if there's one thing the current administration does not seem too keen on doing, it's probably picking a fight with a large bank. So the gut feel is that most of these incentives are actually fairly safe. I know they are associated with the Inflation Reduction Act, which has a bit of mixed meaning depending on who you're talking to. But these are all very valuable incentives that were around before the Inflation Reduction Act and are likely going to be around after. I mean, like Andrew said, the investment tax credit's been around since the 60s. Research and development is around since the 80s. 179D is permanent. It's been around since the early 2000s. 45L, early 2000s. So the gut feel is that they're probably fairly safe. They're also funding that's already allocated, so it's a little harder to pull it back. So if I was going to look into my crystal ball, I would say they're probably fairly safe. But Kristen, take that with a grain of salt because I work in this space. So obviously, I hope everything is fine. But we're fairly confident. The data shows us that we're probably okay. So I just wanted to address that. And last question here. Okay, funding gap. Jeremy, it may be interesting for you to look into PACE loans. I don't know if you've already looked into that before, but PACE loans are basically for energy efficiency projects. So they can be new construction, they can be renovation. I'm not exactly sure what the root of your question is, but we work with a number of PACE providers who are really good for helping secure additional funding during construction. What we tend to see is you do like a PACE loan up front, and then you layer on like a 179D or a cost segregation or a Section 48 in the end. That way, you're really maximizing the ROI in a construction project. Get money in the front, get tax deductions on the end. So honestly, I think that covered most of the questions. Sorry for the rapid fire answering questions at the end here, but I wanted to make sure we got through as much as we could. But honestly, if you have any other questions, please reach out to us. You've got our information. You saw pictures of us. You can go find us on LinkedIn if you want to, but this recording will be available. So if you're looking for it later, everything should be all set. And with that, thank you, everyone. I appreciate the time. Have a great day.
Thank you, everyone.
Thanks, everyone. Have a nice one.